Welcome to another episode of Sunday Stats. This is where we examine some trading data and methods to try to crush certain limiting beliefs or challenge, at least challenge the way we're thinking and open up our thought process to the possibilities. So what I thought I would do today is a little experiment with this. This is random.org. It's a coin flipper. I'll link to it in the description box below, and essentially all it does is simulate in accurate fashion a random coin flip. So I've chosen Thomas Jefferson, and what I'm going to do is let me just write out the rules here on the screen. So we're going to have 4 entries a day, 4 entries per day, and we are going to do those entries at 2 o'clock, 3 o'clock, 4 o'clock, and 5 o'clock. That's because those are the most liquid times of the Japanese yen market, or at least those 4 hours occur within the liquid times. So 4 entries, 1 at 2, 1 at 3, 1 at 4, and 1 at 5 here in Central European time. And we're going to do a 7.5 tick stop and a 15 tick target. Now, what result should we get with random entries? If we enter randomly, we should be right 33%. Our stop should be hit twice as frequently as our target is twice as big as our stop. So we should hit the stop 66% of the time without the decimal places, and then hit the target 33% of the time. So a third of the time we hit the target, and 2/3 of the time we hit the stop. So what result should we expect? We've covered this in another video. We should expect $0 mark to market on our trades. That means if there were no costs, we should expect 0. But as we've got spread, which is going to be $6.25, which is a half tick on the Japanese yen, we've got spread and we've got commissions. And commissions with top step is 368, so we'll just go with that. So each trade we take should end up with a net average loss of minus 625 minus 368, which is 389.93, 993. That looks like, yes, 993. That's what we should expect. We're going to take 4 trades a day. We're going to do 5 days. So what we should get is 20 lots of minus 993 down. So whatever that is, just shy of $200 is what we should lose with random entries. But the difference we are going to make, and this is what I want to test, is what happens if we scale in to winners at logical points. So taking this chart here as an example, let's just say we were long for whatever reason we were long here, and our stops here, and our 2 times stop target is up there. When we see a gap or a reversal candlestick, such as here, we just add here, and we put the stop in wherever it needs to go to maintain the original risk. So the blended entry is here, much like I do in my own trading, and then the stop will go here. Well, no, it will go half, so it will go somewhere around here. But wherever, needless to say, wherever the stop is, it needs to be exactly what it would have been with one contract. And then we let it ride to the target. The theory is, and of course 20 trades isn't really enough, but it's just an interesting experiment to run. The theory is that if you scale in and you manage your risk and you push your winners and you keep your losers less leveraged than your winners, that even with a random entry, we should be able to be at least more profitable than random. So I'm going to stop this part of the video here and get on with testing that. I'll probably show it here with some background music and speed it up so that you can see what I was doing, and then we'll discuss after and see what kind of result we got. So back in a bit. So here's the result, Monday through Friday. This is what we got. Let me just explain what we've got in front of us here. So plus 13.5 means plus 13.5 ticks on the blended 2 contract entry. So that's in fact 27 ticks on 1 contract. 14 is 28 on 2 contracts. 12.5 is 25 on 2. But as this is only 1 contract, so we have minus 7.5 ticks. So we are scaling in and leveraging the power of the market going in our favor when it does, and just losing with less leverage, hopefully over time when it doesn't, based off of candle signals. So that gives us 72.5 gross ticks per contract, and then in brackets here, that comes to 906.25 gross, and then in brackets is the 2, 4, 6, 7 round trip trades, because if you consider a 2 contract trade, 2 contracts in, 2 contracts out, that's as if you took 2 separate trades. So 7 trades, 906.25 minus this commission. And I've just done the same for the other days, 12.5 on 2. You'll notice that we've won heavily on our winners by scaling in and not really considering what might happen if the trade goes against us, because of course it will. And you can see here minus 3.75 on 2 contracts. That may well have hit the blended entry stop, but not hit the original stop and gone to a 15-tick target. So that's all part and parcel of pushing winners. Some are inevitably going to fail, but over time, if there's edge, it will reward you. Then you got 7.5 here on 1 contract, so that ended up with a pretty much a washout day, 2.5 ticks, which is $31.25 minus the commissions. Same thing on Wednesday, loss on 2 contracts, loss on 1, gain on 2, loss on 2, and that ended up with 3.5 ticks, $43.75 gross minus the commissions. Thursday was just 3, no, actually that's Friday. Thursday was a loss on 1 contract, a loss on 2, but even when we're losing on 2, we're losing the same as if we lost a full stop on 1, so we're containing the losers and pushing the winning circumstances. Plus 11 on 2 is plus 22, which is larger than the 15-tick target, and that's where the magic lies, in risk management and money management. Then we lost here again, 7.5, excuse me, 7.5 on 1 contract, so we ended up with $0 gross minus commissions. And then on Friday, 4 straight up losses on 1 contract for minus 30 ticks on 1 contract minus these commissions. Now the net total, and bearing in mind, as we're going to go through, random over time is spread minus spread minus commissions per trade. So minus spread minus commissions multiplied by the number of trades, i.e. 20 in this case, gives us minus 198.6. So this is what we should expect over time if we just flip a coin and enter the market with a given target, a fixed target and a fixed stop. Because if your target is bigger, the market will compensate. The laws of maths will have it that if your target's twice as big, then you will hit your stop twice as many times. If your target is 3 times bigger than your stop, you'll hit your stop 3 times as many times as you hit your target. So that's random there. But we ended up with $495.85, and this is net, 7.5 times our average risk per trade. This was accomplished with only 6 wins and 14 losers. That's a 30% win rate, which is just slightly lower than what we would expect if we were to flip a coin and have a 2-to-1 reward to risk ratio, which is what we did. 15 ticks gain to 7.5 ticks loss. So my hypothesis is that number one, it's only 20 trades, so you'd have to do this over 100, 1,000, 10,000 to get a more accurate number. And number two, if this is reflective of what we should expect, if this sample size did reflect by chance a bigger sample size, then what we would have expected is 33.3 if we were going random and aiming for a target 2 times as big as our stop. So that 3.33 that's missing is because inevitably some of the losers are going to be trades that would have won had we have left them alone and not added in aggressively. So that's a pretty good, I would expect slightly lower than that over time, because inevitably you're going to shave off some wins by pushing into, as I said, trades that would have gone in favor, but your aggressive scaling in turned those into losers. And so that ends up being a 3.58 to 1 reward to risk ratio. This is an interesting experiment. Again, I want to stress that 20 trades isn't enough, but if you have the time and desire, or you know how to backtest mechanically in TradeStation or NinjaTrader or whatever it may be, it would be worth experimenting with a random entry, a fixed target and fixed stop, and then just making the only variable piling into a winner via an objective method, as I've used. As you will see, if you pause the video or slow it down, because I've speeded up the hour of testing I did, manual testing, I've speeded it up so that you don't have to sit here watching me do that for several minutes or the full hour. If you do slow it down via the YouTube speed control or pause it, you'll see that my add-ons were using the same method I use in my actual trading in the combine, which is adding in on confirmation of support or resistance depending on the direction of the trade, and then blending the stop so that I don't lose more than the original one contract trade, and hopefully the trade will continue to go in favor. If the candles don't lie, they lie in the short term, but over time they provide an edge. And so I hope this was useful for you today. Like this video if you want to see more stuff like this in the future. And yeah, I would encourage you to have a go yourself with your favorite market. It's got to be liquid, and you've got to have a set way to scale into the wins. But apart from that, it looks like a random approach may well be what many of us are trying to do in gaming the market and trying to be intelligent. Just my advice is to just follow your rules, dumb it down, and just let the market express itself and ride it hard when it goes in your direction. So that's all I've got for you for now. See you tomorrow in Top Step Traders update, which will be day 16. Bye for now.